So all the speakers know that the one thing that Brad has beaten into us is not to be self-promotional. So I'm not allowed to say anything to promote Blue Vista, but let me say that this is the best looking German audience I've seen in a very long time. Uh, all right, with that, let me first start by describing what the middle market is, because I think quite often people have biases based upon where they grew up, the country they live in, where they've traveled to, their understanding of what is an investable asset class, what isn't. And so the first thing I think is just to develop an appropriate sense of what exactly the middle market is. Then I want to touch on Blue Vista's approach. This is actually out of order, I think. Maybe I'll change. I don't know if this is the most recent version of the presentation, but that's okay. I'll free will. Then what I want to do is cover why U.S. real estate remains attractive, and then I'll talk about how you generate alpha by investing in the middle market. Okay, so our definition for the middle market follows real capital analytics, which is transactions that fall between $5 and $50 million in size. This covers virtually every property type in the U.S. It includes apartments, office, industrial, retail, hotels, self-storage, senior housing, on and on and on. In addition, it's located throughout the entire U.S. Every major metro, suburban location, and even secondary and tertiary markets contain these types of assets. An important thing to note is that the U.S., with over 320 million people, has over 160 metro areas that have over 300,000 people. So that type of density all over the country creates a large investable universe. And I think one thing that's absolutely critical and hasn't really been discussed in many regards today is that you can fall in love with population growth, you can fall in love with job creation, but the truth of the matter is you need to understand barriers to new supply and also the entry point of your economics in a deal. So you can get as excited as you want about a high growth market, but if you're paying a lot to enter into that market, that fundamentally limits your ability to generate alpha. So, just so we can see some pictures of real estate. And the funny thing is, we have no pictures in our office of real estate because we're solely focused on returns. But this shows you office buildings, retail centers, industrial buildings, more office. Looks like we stole the same picture of the Amazon facility there. Flex office, senior housing in the upper left, self-storage on the right or your left, and then multifamily or apartments. So our approach is focused on going after the middle market because we believe there's fundamental asymmetry in information and there's also better pricing available than the major markets. So I don't know if any of you have heard of Oaktree, but the founder of Oaktree is a guy named Howard Marks, who's a great value investor. And before we go into the middle market specifically, he in a recent letter talked about the 6 different strategies an investor can do in the current environment. And I think it's really great, regardless of whether you're talking about real estate, even as an individual investor, I think it's a very good discipline. You can either, in a yield-constrained environment where there's a lot of uncertainty, you can either go to cash because you're scared. Obviously, you're going to get very, very low returns. You can change your strategy to reduce risk and also accept the fact that you're going to get lower returns. Third, you can keep the same strategy and just take the returns that the market's going to deliver to you, which will likely be lower than what it has been historically. 4, you can unrealistically pursue the same strategy and think you're going to get paid the same as you have in the past. 5, you can increase the level of risk in your strategy and hope for higher returns, so you're taking on greater risk to get the same level of return. Or 6, pursue strategies with a specialized approach that you believe can deliver higher returns for the same level of risk. So that's 0.6. And that's what we think the middle market offers. So, again, as I mentioned, middle market transactions between $5 and $50 million. It's a very large opportunity set. I'll go through the numbers with you shortly. And we think it provides very attractive returns relative to transactions above $50 million in size. Secondly, there's been a long-term persistent cap rate arbitrage between major assets and middle market assets. The general perception is that there's greater liquidity in the major markets and the major market assets, but that's actually not the case. Smaller transactions have more people who can participate in them and therefore provide equal, if not better, liquidity. Third, you have the ability to provide greater diversification with your investment dollars. We believe diversification is the #1 risk mitigant any investor can pursue in enhancing their returns and reducing risk. It also enables you the ability to diversify by property type, by geography, and also investment strategy. As I mentioned, the size, which I'll touch in a second, is so robust that it provides ample liquidity for investors, and there's a very diverse group of investors, whether they're family offices, local players, regional investors, institutional investors, public REITs, as well as integrated owner-operators. So over the past 20 plus years, as you can see, if you look at the sheer number of transactions between $5 and $50 million account for over 8 times the transactions in the middle market. So it's a much broader set of investment opportunities. So view it as almost like small cap stocks. There's a lot of them out there. There's not as much analyst coverage, so you've got to get your hands dirty to dig through the opportunity set. But importantly, it's about 80% of the dollars that flow into transactions above $50 million in size. So it's a very deep market. Over $75 billion worth of transactions in the middle market in the US last year. So while we're seeing that major market valuations, and if you follow the Real Capital Analytics information and what some of the speakers have said today, that the 6 gateway markets, for example, in the US have hit peak valuation levels. That's not true in many of the middle markets. In addition, there are specific value add opportunities in these submarkets where there are still compelling arbitrage opportunities in terms of the ability to enhance asset values and deliver a spread between projected exit cap rates, meaning higher cap rates on the going out on a transaction as opposed to what you're entering into versus the current market. And then also, these smaller assets, the market generally pays for portfolio aggregation. So in many of the asset types, when you have smaller unit sizes, pulling together a portfolio creates a portfolio premium. While there are some markets that in the middle market that have hit peak pricing, by using protected equity strategies like participating preferred equity structures, you can protect yourself to the downside, just as we heard from on the square mile debt side. We believe preferred equity provides very interesting elements. We like it because it provides the ability to have influence in decision making, which a mezzanine lender cannot have. There's a fundamental issue between mezz debt and preferred equity in that regard. And then a disciplined approach to investing in the middle market is what's required. You can't use emotion because these are generally more commodity-like assets, so you need to be able to understand and measure and price risk appropriately. As you can see, this chart basically shows some strategies that we believe are particularly compelling based upon long-term data that we track in terms of risk premiums and pricing, and we compare the middle market to the major market, not only by property type, but also over periods of time. Generally speaking, the middle market has got anywhere from a 10 to a 13% better risk-return relationship in terms of cap rates versus underlying income. And as you can see, right now, we believe we're at a point in the cycle where on the value add multifamily side, at a national level, your unlevered rates of return in value-add multifamily are actually at the low end of the historic spectrum. There's a lot of capital chasing multifamily and the value-add strategy approach in particular. We think the ability to move rents as significantly as a lot of people think is very challenged. Generally speaking, we're seeing value-add multifamily strategies on an unlevered return basis delivering below 8% total return. That's unlevered returns over a 5-year period. All right, so maybe I've established that the middle market is attractive, maybe not, but more importantly, why would you even look at the US right now, given what's going on? So there's been a decline in transaction activity. We've seen some prior slides. Generally speaking, last year was about 10% down. A big chunk of that was related to major market investment activity. However, capital is continuing to flow because of the challenge in a low yield environment for investors to generate sufficient returns, whether they're insurance companies who need to meet policyholder obligations, pension funds who've got to meet retiree obligations, or individual investors who are trying to generate total return. Generally speaking, supply and demand is still healthy and balanced in the US. There's been a lot of discussion about the constraints on construction lending. Construction lenders in the US, generally speaking, have better access to information. So back in the 80s, you could literally have 4 lenders lending on 4 different street corners on the same type of asset without knowing what was going on. That just doesn't happen anymore in the US. Also, risk premiums are basically at long-term averages. One of the other things that we really focus on are mortgage credit spreads. We believe mortgage credit spreads are a very important leading indicator of risk in the US in terms of risk to asset pricing. There's been a lot of discussion about inflation. I could go on and on about it. I personally believe that while there's going to be some short-term pressure applied by the Fed to slow down the economy, and in particular focused on wage growth, I believe there are more deflationary forces in the US than there are inflationary forces, those being the ballooning public and private debt balance in the US. Debt is fundamentally deflationary. Secondly, we've got a massive bubble of retirees that are going to reduce consumption and demand income to support themselves. And even if they have to work longer, generally speaking, the savings rate is so low and the earning potential of the people who have not saved for retirement is actually very low. So their ability to generate a lot of income to be able to absorb higher prices in goods and services is very limited. And so as a result, I would say a cautious, diversified, risk-measured approach to investing with modest leverage, we believe can continue to generate attractive returns. We're going to be in a long-term low-yield environment for the rest of our lives. If anyone doubts that, there's an incredible McKinsey Global Institute study that has a very sobering projection of what an institutional investor should expect to return over the next 30 years. And it's absolutely terrifying in terms of population growth in the developed world, retirement rates, productivity growth, and so forth. But we're going to be in a low return environment for a long time. Also, quantitative easing is coming to an end, obviously, in the US, soon to be followed by Europe and then followed by Japan. All those forces are going to actually, obviously, have an impact on risk asset pricing. So cap rates will likely be moving up. We expect it. We price off of the forward yield curve. So in all the deals that we evaluate, we're looking at 5-year or 10-year forward treasuries, and those yield curves have moved significantly to reflect this. Obviously, the Tax Act took care of the fear of recession. I don't know if everyone remembers, but basically before the Tax Act was passed, the yield curve was very flat and people were concerned about a recession in the US, but that is not the case anymore. GDP growth is obviously still positive, but it's not going to explode in terms of size. There's a whole debate as to actually long-term ability to move GDP without having significant population growth, and actually both birth rate and immigration in the US are down, which will have an impact in terms of GDP growth. There's been a bunch of discussion already about the sheer quantity of capital, 10.3%, that's been allocated globally by big investors to real estate, and how the US is the deepest, most liquid, most attractive market for investors. That's going to continue to attract capital unless we get into crazy trade wars and other policies that the current administration seems to be pursuing. But I believe that those are short-term in nature, because I don't think that the US will persist on this path for long. And then one of the other things that's been mentioned is that there is significant uncertainty in the tax legislation. There are so many areas for interpretation, in particular with real estate, not only for foreign investors, but also domestic investors. So the ultimate impact of the Tax Act on the real estate industry is really uncertain. And one of the biggest, which hasn't been discussed at all, is the impact on changing capital gains treatment from 1 year to 3 years. That in and of itself you could have an entire conference on, and the impact on developers and developer behavior, because developers now will have to hold on to assets for 2 years longer to get capital gains treatment, and that means significantly enhanced risk for them, as well as significantly enhanced risk for the equity who's been backing them. I'll skip this slide. We've already talked about this in terms of the increasing demand for real estate. And then finally this point here, which is mortgage credit spreads for both multifamily and commercial. As many of you know, on the multifamily side, the GSEs, Fannie Mae, Freddie Mac, have been very supportive and accommodating. They've had unbelievable credit characteristics. They've had very low default rates and very low loss rates. And as we see that the band of credit spreads right now is in an attractive and also historic average rate, which we think is encouraging.